Welcome to episode 85 of Canadian Mortgage Weekly. Today, I am going to be covering off a awesome topic as we close off Mortgage Products Month. So this is going to be a really good episode. It's going to have lots of great information for a very select group of individuals and clients that we work with quite often to qualify for a mortgage even when they do not have a typical or traditional income, because today I'm going to be chatting with you about unique and no income mortgage products. And again, just 5 things to consider about that. So as we're heading into Canada Day weekend, thank you guys all for tuning in and checking out today's episode. It is again just myself. We do not have Joe with us this afternoon for today's episode, but he will be back for next week when we jump into our next month's topic. So again, chatting about unique / no income mortgage products. So the first consideration is, who is it for? Is this really for me? Is this something that pertains to my situation or my scenario? And again, most of the typical mortgages that you're going to go through, get qualified for, get documentation for, all of those things are going to require certain documents to verify that income, such as maybe a letter of employment, T4s, pay stubs, and maybe your industry is something that doesn't give out those types of documents or doesn't provide that type of information. We see this a lot in areas such as commission, if it's 100% commission. Sometimes we can look at T4s for that, but depending on the industry, it may not be something that they can really get for you in terms of, pay stubs, letter of employment, those types of things. So again, these types of mortgages can help you actually get a mortgage, qualify, and bypass some of those typically required documents that can otherwise tie you up. And a good rule of thumb for this is, at this stage, is it for me? If you're asking yourself or considering, does my income qualify? If you're maybe not too sure, it's at least worth it to reach out to our office, chat with myself, Joe Bladdock, or Terry Lynn, and we can look at the correct mortgage product for you, whether that is one of these special programs, or if we can do it, as a traditional, fully employed T4s, pay stubs, letters, all of those things. So back to no income or unique income products. How do they work? So again, they're qualified under different terms, which is why there is different documentation that's needed. This again is typical for commission income. If you're looking to qualify for, using rental income, or net worth income, equity programs, things like that, that again don't necessarily require documentation. So the lender will qualify you based on income from those different fields. Again, if it is rental income or you're getting 100% commission, no base salary, things like that, the lender will use the documents pertaining to that field to qualify you. Again, sometimes alternative documentation is required depending on what the field is. Again, sometimes if it is things like commission income, we will look at bank statements in order to see what commission incomes are coming through, or different expenses that you might have at your job in that specific field. But to sort of make it work for the lender, sometimes we do see this is at a higher rate to qualify these types of mortgages, and sometimes there can also be lender fees involved as well. But again, it does help you qualify for a mortgage where a typical lender may have issues. And again, the beauty of working with a mortgage broker is, especially at our team, we like to consider ourselves problem solvers. So if you went, directly to a branch and maybe they just did a sit down with you, looked at your income, and maybe they figured it wouldn't qualify. We also do have alternative lenders, B options, and those sort of things. And they're typically the ones that offer these products for people that, maybe don't have a stable or secure income, but have lots of equity or have rental income, and they're looking to get in the market and get a mortgage as well. So I talked a little bit about it, but consideration number 3 is going to be, what do I need? So many times the lender is going to require bank statements. So this is going to confirm regular income, whether that's commission income, all those expenses that are involved. If it's dividend income that's being deposited, any rental income as well. If you are looking at getting approved based on rental income as your primary qualifying income source, we will likely need appraisals, or if it's an equity program, we will need appraisals for those properties to confirm that you have that equity. I know that if you've been tracking Canadian Mortgage Weekly, you've likely seen that our tracker for where the Canadian National House Price average has dipped off pretty low and has definitely slowed from what we saw previously. So appraisals are really important to make sure that the lender can verify exactly how much equity you have or net worth, or making sure that rental income. And looking at what it costs, there's going to be standard legal fees and things that are associated with a typical purchase or refinance, legal fees, land transfer taxes, typical closing costs. Again, there could be an additional appraisal fee if it is a type of income or the style of the deal needs an appraisal or requires an appraisal. That could be an additional cost. And again, depending on the lender and the product that we can get your income to qualify under, there could be additional lender fees and broker fees. So those are just small things to consider. But again, when it's a consideration of not getting into the market versus getting into the market with these, maybe slightly higher rates, usually we find that the client benefits from gaining that equity and having a claim and a stake on a real property in Canada. And why would you want it? So it is typically easier to get an approval for these styles of mortgages, as odd as that may seem, because typically the lenders we work with have that compensated higher rate for what's considered on their end a higher risk mortgage. So we do find that they are a little more lenient than a typical, prime A lender, giving you the best rate. Those ones are considered, lower risk mortgages for the lender, but they require a lot of documentation and a lot of things to make sure everything is lined up appropriately. But we do find that typically there are less documents, less stress, more flexible lender terms. We can more easily look at things that a typical prime A lender wouldn't be able to service. We can look at making sure that the lender on that end can service it, and typically they can, again, with less documents, which does create less stress. A lot of our clients do find the document process to be quite extensive, so shaving off some time, getting documents together, needing less, and qualifying for more in some cases, it does add to a less stress mortgage journey from the start to the very finish. And they typically do have generous prepayment privileges. I know that this is, again, something to consider, and something that some of our fixed rate clients have noticed when they look at refinancing or doing a sell by having to break that mortgage. Sometimes the penalties can be quite high, but with a lot of these lenders, there are generous prepayment privileges, meaning higher lump sum amounts that are allowed, increasing the percentage or amount per mortgage payment, things like that. So this concludes the 5 things to consider when looking at a no income or unique income programs and mortgage products. So definitely reach out to our office, chat with myself, Joe Bladdock, or Terry Lynn, and we can look at getting your, your needs serviced and making sure that, we can see where your income's coming from and the proper mortgage that will fit, your situation and help you actually get in a position where you can qualify by looking at the correct lenders and the correct mortgage products for you. This also actually does conclude June's month on mortgage products. So we did cover tons of really good information on the different mortgage products that are available. I know that we looked just last week at reverse mortgages, and we're moving on next month to all about transferring or renewing your mortgage. So important things to note, because you do, it is actually a pretty crucial time for your mortgages, whether you're looking to, we'll cover topics like negotiating your term, your timeline for when you start, which is going to be next week's episode. So join us next Thursday at 11:30 a.m. for episode 86, where we're going to cover how much time do I need to transfer or renew your mortgage. We want to save some stress and make sure that there's a proactive approach, so that, we're not reacting within a week to, my mortgage is renewing 2 weeks from now. Let's get it started. Well, we might need a bit more time for that, but we'll cover that in next week's episode. So thank you so much for watching. Add a comment below, subscribe to see more of Canadian Mortgage Weekly, Canada's video mortgage news podcast. We do not have news coverage for this week, but next week we will be covering off the regular mortgage news statistics, looking at the bond yield, what's happening on the rate side, and we're going to be warming up for our Bank of Canada interest rate announcement, which I believe is on July 13th. So you don't want to miss that live coverage as well. But that does conclude today's episode. We hope you guys all have a great Canada Day tomorrow and enjoy your Canada Day weekend. Thank you so much for watching.